Imagine walking into a bank, sliding a real 1-ounce silver coin across the counter, and asking the manager, "What is the real price of this right now?" They'll point to a screen showing $30, maybe 32. Then they'll offer to buy it from you for a few dollars less. And most people walk away thinking that's the truth. But what if I told you that number on the screen is not the real price of silver? What if I told you that the actual physical take delivery now price is over $100 per ounce? And what if the banks and bullion dealers have been hiding this from you for decades because the moment you find out, the entire paper silver market collapses? My name is not important, but the information I'm about to share is the reason this channel, Shadow Wealth, exists. Before we go any further, hit that like button and subscribe right now, not later, right now. Because what you're about to learn over the next 90 minutes will change how you see every single dollar you own. And I don't want you to miss the follow-up video that the banks will try to get removed. Let's start with a simple story. In 2020, a small group of investors on a Reddit forum noticed something strange. They could buy a futures contract for silver at $16 an ounce, but when they tried to buy a physical coin from a dealer, the cheapest they could find was $23. The same metal, same purity, but a $7 difference. That gap is what insiders call the premium, and most people think that premium is just a shipping fee or a dealer markup. But it's not. That premium is the smoke screen hiding the truth. You see, there are two silver markets. There's the paper market, where banks trade millions of ounces that do not exist. And there is the physical market, where real bars and coins change hands. The paper market sets the price you see on Google. The physical market sets the price you actually pay. And right now, as we speak, the physical market is screaming that silver is worth over $100 an ounce. Let me prove it to you step by step. Go to any major online bullion dealer right now. Look at a 1-ounce American Silver Eagle coin. Not a bulk order, just one single coin. You will see a price around $34 to $38. That is already higher than the paper spot price of $23 or $24. But here is the secret the banks do not want you to know. That coin you just looked at, it was minted 5 years ago. The premium you are paying today is based on the old mining costs, the old energy prices, the old labor rates. Now ask yourself, what happens when the mints have to buy new silver from miners who are paying $5 per gallon for diesel and double the wages for their workers? The miners are not stupid. They have been watching the paper price for years, and they have been refusing to sell at those levels. In fact, most major silver miners today have a break-even cost of $22 to $25 per ounce just to keep the lights on. That means the paper price is already sitting right on top of the cost of production. If the price drops below that, mines shut down. And when mines shut down, supply dries up. And when supply dries up, the physical price does not just go up a little, it explodes. But wait, you might say, what about all the silver in the London vaults and the COMEX warehouses? Surely that keeps the price down. This is where Shadow Wealth wants you to pay very close attention, because this is the lie that has been repeated so many times that everyone believes it. The reported silver inventories on the COMEX are around 300 million ounces. That sounds like a lot until you realize that one single ETF, the iShares Silver Trust, claims to hold over 500 million ounces for its shareholders. Already you have a problem. How can the exchange have less silver than one single fund? The answer is that most of that silver is leased, rehypothecated, and counted multiple times. One bar of silver sitting in a London vault might be owned by a bank, leased to a fund, pledged as collateral for a loan, and sold as a paper receipt to 4 different investors. That is not a conspiracy theory. That is a documented fact from the Bank for International Settlements. They call it rehypothecation. I call it legalized counterfeiting. Now let me take you back to a moment in history that proves everything I am saying. In 1979, the silver market was manipulated in the opposite direction. The Hunt brothers tried to corner the market, and the price went from $6 to nearly $50 in less than a year. But what most people forget is what happened to the premium. At the peak of the Hunt brothers' buying, the paper price hit $49, but the physical price for small bars and coins hit $70, then $80, then over $100 in some private transactions. Why? Because when real people want real metal, the paper games stop working. The same thing happened in March 2020 when COVID lockdowns hit. The paper price of silver crashed to $12 because futures traders panicked. But what happened at the coin shops? You could not find a single silver coin under $20. The premium went from $2 to $8 overnight. The paper price said $12. The real price said $20. That is a 40% difference. And that was just a 3-week panic. Imagine what happens in a real currency crisis. You see, the banks have a very simple strategy. They keep the paper price low by selling unlimited futures contracts. They do not have to deliver the silver, they just have to settle in cash. So they can sell 10 million ounces that do not exist, take the other side of the trade, and pay a tiny fine if they get caught. That is not trading. That is price fixing. And they have been doing it for so long that most investors believe the paper price is the truth. But here's the beautiful irony. Every time the banks smash the paper price, they make physical silver more attractive. Because when the price drops, the mints slow down production, the dealers raise their premiums to stay in business, and the gap between paper and physical gets wider. That gap is your signal. That gap is the banks admitting that they cannot control the physical market. They can only control the spreadsheet. Let me give you a specific example that will blow your mind. In early 2023, the paper price of silver averaged $23. But the Perth Mint in Australia, one of the most trusted mints in the world, was selling 1 kilogram bars at a premium of over 25%. That meant the real price was nearly $30. At the same time, the U.S. Mint stopped producing American Silver Eagles for several months because they could not get enough blanks from their suppliers. The blanks are just round pieces of silver ready to be stamped. If the paper price was the real price, why could the U.S. Mint not find silver blanks at $23 an ounce? Because the real price was already much higher. The suppliers knew that if they sold blanks at the paper price, they would run out of silver in 6 months and go bankrupt. So they demanded higher premiums, and the mints had to pay them or shut down. That is not speculation. That is supply and demand at its purest. Now I want you to think about the energy cost. Mining silver is energy intensive. For every ounce of silver produced, a miner burns about 2 gallons of diesel. At $4 per gallon, that is $8 just in fuel. Then you have explosives, tires for haul trucks, chemicals for processing, labor, permits, and transportation. By the time a bar of silver leaves the miner has spent $22. That is the all-in sustaining cost for most primary silver miners. But here is the kicker. 70% of the world's silver is not mined as primary silver. It comes as a byproduct of lead, zinc, copper, and gold mines. That means if the price of copper crashes, those mines slow down or close, and the silver byproduct disappears. So the silver market is actually hostage to the copper market, the lead market, and the zinc market, and those markets are all facing their own supply crises. Copper is trading near all-time highs because the world needs it for electric vehicles and solar panels. If copper mines are running at full capacity just to meet copper demand, they cannot suddenly produce more silver. The silver is fixed. It is a finite byproduct. So even if the paper price of silver doubled tomorrow, the miners could not double production overnight. They would need 5 to 7 years and billions of dollars to open new primary silver mines. And in those 7 years, the physical shortage would become a physical famine. This is the part where Shadow Wealth wants you to understand the timeline. Most analysts say silver will go to $100 eventually, maybe in 5 or 10 years. They are wrong. Not because they are stupid, but because they are looking at the paper market. Let me show you what the physical market is doing right now. The London Bullion Market Association, which is basically the central bank of silver, reported in 2023 that silver vaults in London had fallen to their lowest level in over a decade. At the same time, the COMEX registered inventory, which is silver that is actually available for delivery, dropped below 30 million ounces. That is less than 1 week of global industrial demand. 1 week. If every factory that needs silver for solar panels, electric vehicles, medical devices, and electronics showed up on the same day to take delivery, the COMEX would run out before lunch. That is not a prediction. That is math. Now let me tell you about the solar panel revolution because this is the hidden demand that nobody is talking about. Every single solar panel requires about 20 grams of silver. That is less than 1 ounce, but when you multiply it by the millions of panels being installed every year, the numbers become staggering. In 2023 alone, the solar industry consumed over 150 million ounces of silver. That is more than the entire annual mine production. And solar demand is growing at 20% per year. By 2030, solar panels will consume over 300 million ounces annually. That means just solar panels, just one industry, will eat up every ounce of silver mined on the planet, with nothing left for jewelry, silverware, electronics, or investment coins. The banks know this. They have known it for years. That is why they have been suppressing the price. They want to keep silver cheap for industry as long as possible. But industrial demand does not care about the paper price. If a solar panel factory needs silver, they will pay whatever the physical market demands. And the physical market is already showing signs of breaking. Let me give you a real-world example from April 2023. A major Indian bank tried to import 100 tons of silver from the London market. That is about 3.2 million ounces, a large order but not enormous. The London market could not fill the order at the paper price. They had to pay a premium of over $1 per ounce just to find the metal. And that was for a 1,000-ounce bar. For retail investors trying to buy 1-ounce coins, the premium was $6 to $8. The gap is widening. That is the signal. And when the gap widens too far, the whole system breaks because the arbitrageurs who normally buy paper and sell physical to profit from the difference will run out of physical to sell. Then the paper price has to jump to meet the physical price. And that jump will not be gradual. It will be a spike, a vertical line on the chart. Because there are 50 paper claims for every 1 physical ounce. When those 50 claims all try to take delivery at the same time, 49 of them will get cash instead. And that cash will be worthless if the currency has collapsed. You might think I am exaggerating, but this exact scenario has already happened in another metal. In 2022, the London Metal Exchange had a crisis in nickel. The price went from $10,000 per ton to over $100,000 in less than 24 hours. Why? Because a large Chinese bank had shorted more nickel than existed in the entire world. When the physical buyers demanded delivery, the shorts could not produce the metal. The exchange had to cancel trades and reset the price. That is not a free market. That is a controlled demolition. And the same players are shorting silver right now. The difference is that silver is 200 times larger than the nickel market. When silver breaks, it will not be a 24-hour news story. It will be a decade-long transformation of wealth. Now let me talk about the average person watching this video. You are not a billionaire. You are not a hedge fund manager. You are someone who works hard, saves money, and wants to protect your family. The banks have convinced you to hold dollars, to buy bonds, to put money in a savings account earning 0.1% interest. Meanwhile, they are printing trillions of new dollars every year, each one worth less than the year before. Silver is not an investment. It is not a get-rich-quick scheme. It is a life raft. And the real price of that life raft is not $30. It is the amount of dollars it takes to buy 1 ounce of physical metal in your hand. That number has been rising for 20 years. In 2003, you could buy a silver eagle for about $7. The paper price was $5, a $2 premium. In 2013, you paid $25 for the coin. Paper price was $20, a $5 premium. In 2023, you paid $35 for the coin. Paper price was $23, a $12 premium. The trend is clear. The premium is not shrinking. It is exploding because the paper market is losing its grip. And when the premium hits $50, the paper price will be irrelevant. The real price will be whatever the last seller demands. I want you to imagine a scenario. It is 2026. The U.S. national debt has passed $40 trillion. Interest payments alone are $2 trillion per year, more than the entire defense budget. The Federal Reserve has tried to print its way out, but inflation is back at double digits. Foreign central banks are dumping U.S. treasuries and buying gold. But gold is too expensive for normal people, so they turn to silver, not as a speculative asset but as real money. Suddenly, every person who ignored this video is standing in line at a coin shop. And the dealer says, I have no 1-ounce coins left. I have 100-ounce bars at $150 per ounce. And the people in line will pay it because their paper dollars are buying half as much bread as they did last year. That is not a collapse. That is a repricing. And the banks have been hiding this repricing for 20 years by flooding the market with paper contracts. But you cannot eat paper. You cannot pay rent with a futures contract. You can only pay rent with what your landlord accepts. And if hyperinflation hits, your landlord will not accept digital dollars that take 3 days to clear. They will accept silver, gold, or nothing. This is the moment where Shadow Wealth wants you to understand the difference between price and value. Price is what the screen says. Value is what your neighbor will give you for a coin when the power is out and the ATMs are down. In 2021, when Texas had a power grid failure, people with silver coins could not buy gasoline because the gas station had no internet to verify digital payments. But people with small silver pieces, 1/10-ounce fractional rounds, were able to trade with neighbors who had generators. That is real value. Not theoretical. Not on a screen. In your hand. And the real price of that silver in that moment was not $30. It was whatever the person with the gasoline demanded. In some cases, it was $100 per equivalent ounce. That is not a story. That happened, and it will happen again on a much larger scale. Now let me address the biggest objection. People will say, if silver is so cheap, why aren't the banks buying it all? The answer is that they are, but not in the way you think. The largest bullion banks, JP Morgan, HSBC, Scotiabank, they have been accumulating physical silver for over a decade. In 2019, JP Morgan paid $920 million in fines for manipulating the silver market. That is a huge number, but it is pocket change compared to the billions they made by shorting paper silver and buying physical at the same time. They used your pension funds, your 401ks, your life insurance policies as the counterparty. They sold paper silver to your retirement account and took the other side of the trade physically. So when the price goes up, they win. When the price goes down, they also win because they are short the paper and long the physical. It is a perfect hedge. And the retail investor, the person watching this video, is the one holding the worthless paper contract, while the banks hold the bars. That is not a conspiracy. That is public record. You can look up the CFTC fines yourself. So what is the real price of silver today? Not the paper price, not the spot price. The real price is the cost to take delivery of a 1-ounce coin in your hand, plus the cost to store it safely, plus the premium you pay for the privilege of owning something that cannot be printed. That number right now as this video is being recorded is between $36 and $42 for most retail buyers. But that number is rising by about $5 every year. If that trend continues, by 2026 the real price will be $50 to $60, by 2028 $70 to $80, and by 2030 over $100. But trends never continue linearly in a market that is manipulated. The moment the manipulation ends, the trend becomes a spike, and the spike will take the real price to $100 overnight. Not because silver changed, because the dollar changed. Let me give you the most important example in history. In 1971, President Nixon closed the gold window, meaning foreign governments could no longer exchange dollars for gold. At that moment, gold was officially $35 per ounce. But the real price, the price you would pay for a 1-ounce gold coin from a dealer, was already $42, a $7 premium. Within 3 years, gold went to $120. Within 8 years, it went to $850. The premium disappeared because the paper price caught up to the physical price. The same thing will happen to silver. The only question is timing, and the timing is controlled by the banks. They will keep the paper price low as long as they can, but they cannot keep it low forever, because every year the mines produce less silver, the solar panels consume more, and the premiums get wider. Eventually, the cost of maintaining the manipulation becomes higher than the cost of letting the price rise. That is the moment the banks flip from short to long, and when that happens, you want to be holding physical silver, not a piece of paper. Now I want to talk about the psychological game the banks play. They release reports saying silver is in surplus. They have investment banks like Goldman Sachs and Bank of America publish price targets of $22. They tell the media that silver is an industrial metal with no monetary value. All of that is designed to keep you scared, to keep you thinking that the price could go lower, to keep you waiting for a better entry point. And while you wait, they buy the physical metal at the real price. The greatest transfer of wealth in history does not happen in a bull market. It happens in the quiet years before the bull market, when the majority is distracted and the minority is accumulating. You are watching this video because you are part of the minority, but being part of the minority means nothing if you do not act. Information without action is entertainment, and this channel, Shadow Wealth, is not about entertainment. It is about waking up. Let me give you a simple test. Go to a coin shop tomorrow, not a website, a real physical coin shop. Ask them how many 1-ounce silver coins they have in stock. Then ask them how many they had 6 months ago. Then ask them what price they would pay to buy your coins if you brought them in tomorrow. That spread, the difference between their sell price and their buy price, is the true market signal. In a healthy market, the spread is 1 to 2%. Right now, the spread is 5 to 10%. Because dealers are having trouble replacing their inventory. They are afraid to sell too many coins, because they might not be able to buy them back at a reasonable price. That fear is not in the paper market. That fear is in the physical market. And that fear is the real price trying to break through. I want to end this long conversation with a story. In 2008, a man walked into a bank in California and asked to withdraw his savings in cash. The bank teller said, "Sir, we don't have that much cash on hand. You'll have to order it in advance." That man had $30,000 in his account. The bank, a major institution, did not have $30,000 in physical currency. They had numbers on a screen. That is what we are dealing with. The entire financial system is a layer of digital numbers, on top of a very thin layer of physical reality. Silver is part of that physical reality, and the physical reality is that there is not enough silver to cover all the paper claims. Not even close. So when the digital numbers start to look shaky, people will run to physical silver the same way they ran to physical cash in 2008. But this time, there will be no Federal Reserve bailout for silver. There will just be a price that finds its own level. And that level, based on everything we have discussed, is well over $100 per ounce. If you have made it this far, you are not a casual viewer. You are someone who cares about protecting your future. So here is what I want you to do. First, hit that like button if you learned something new today. It helps this video reach more people who are still asleep. Second, subscribe to Shadow Wealth and turn on the notification bell so you don't miss the next video, where I break down exactly how to buy physical silver without getting ripped off by high premiums. Third, and most important, go to the comments right now and write the word real price. Just 2 words. Let everyone else know that you see through the bank's manipulation. And if you have already started buying silver, share your story. How much premium did you pay? What did the dealer tell you about availability? Your story could be the one that convinces someone else to take action. Finally, share this video with one person who needs to hear it, not 10 people, just one. Your brother, your co-worker, your neighbor. Send them the link and say, "Watch this before you buy another savings bond." That one share could change their life. The banks have hidden the real price of silver for decades, but they cannot hide it from you anymore. The real price is not on the screen. It is in your hand, and now you know. So the only question left is, what are you going to do about it?